Ticker symbol FICO is up around 95% in the past year, and today we'll be looking at a clear market leader with a wide moat, which may be classified as the perfect boring stock as it has solid fundamentals, increasing efficiency ratios, but it operates in a sector that has low competition and low innovation. So today we'll be looking at Fair Isaac Corporation, a financial services company. In their annual report, they state that they are the leading applied analytics company which believes that data used intelligently can improve business decisions. I'm aware that all of you, if you're American, you probably know what FICO is, and you probably have a FICO score. But just to give a bit of context, FICO operates and has a score and some analytics which allow businesses to make decisions of whether they should give loans to a certain client or if they should not give the loan based on how likely they are to pay back the loan. The FICO score is already the standard measure in the US of consumer credit risk, and most major banks, credit card issuers, and many other financial entities rely on this software in order to gather the information and decide whether to give out a loan to a certain individual or whether it's better to not give them a loan. And now through the years, this score has been updated with the increase of data importance. When every year that they're able to gather more data from the different clients, they will update their software, include this into the calculations that they use, and update it and keep it check, which improves the score and the credibility of this software. And now, of course, the largest geographic market for FICO is the Americas, which represents around 85% of their total revenue in 2023. Now, this company has one of the best set of financial metrics I have seen in my long career of investing. For example, their return on capital employed is 40%, which is extremely high, as the usual threshold that we look for in this channel is 15%. Then they have an interest coverage ratio of 6 times, which, although below our threshold of 10 times, since this company has such stable revenue, it's okay, and they will be very likely to pay back their own loans. Next, they have a cash conversion of 73%, and they have a very impressive profit margin of 79% with a super impressive operating margin of 42%. Now, this company has a track record of increasing their prices a lot every single year, and this, alongside with the fact that a lot more businesses are now using their services, has allowed their net income to grow by 25% year over year. And as you can see, all the other metrics, revenue, gross profit, and of course net income, have grown every single quarter. Now, when looking at their efficiency ratios, we can see that they are super stable, and their return on invested capital, which is the one we should take a look at from this slide, is around 30%. We shouldn't consider return on equity, as their equity has been negative since September 2021. Now, when looking at their financial position, this is something that does worry me about FICO, where to me, when a company has total liabilities that are above their total assets, I take that as a big red flag, because it usually means that you have negative equity and you owe more than what you have. However, in 2023, it is true that they reduced equity as they increased their total assets by more than what they increased their total liabilities. However, I would take a look and do a deeper dive on this trend and see if they're actually able or willing to get this and revert this tendency. Now, when doing a fundamental analysis of FICO, this company gets a very good 6 out of 8 ticks, as they have low liability risk, which we have discussed previously. They produce extremely consistent free cash flows, which is great for the investor, and they conduct share buybacks, which increases the value and the return on investment of their investors. Now, they have, of course, been growing their revenue organically, which essentially means without the necessity of acquiring a different company. And the most important one of them all, they have extremely large pricing power and a super wide existing moat or competitive advantage. And now, why is this? Well, this company is essential for the correct functioning of many banks or financial entities, where many banks that actually offer loans to their clients could not survive and could not operate without FICO's software. It's so good that these companies sort of blindly trust it, and just by listening to what FICO is telling them about a client, it will decide whether they will get a loan or not, and what kind of interest rate this will obtain. Now, banks have grown so dependent of this credit score, and it has become so widespread in the United States that it has obtained massive pricing power. They're able to increase their prices above the inflation rate every single year, and the banks and financial institutions cannot complain since they don't have any other alternatives that can actually replace the FICO score. However, there are two things that I did not quite like in the fundamental analysis. The first one is that, of course, they do not have a solid balance sheet as their equity is negative, and this to me is a big red flag. But the second one is that in 2023, their free cash flow actually did not manage to grow. Now, this may just be a bump in the road, but I would like to take a further look to analyze what happened last year. Now, when looking at the valuation of FICO, it has gone through the roof. As you can see, last year it has gone from a PE ratio of around 30 times all the way up to a PE ratio higher than 80 times. Now, this of course has been due to the fact that it has become extremely high quality, but I believe that this is excessive even for such a high quality company as FICO. Now, when analyzing their free cash flow yield of 1.44%, this is lower than half of the long-term inflation rate, 3%, which also deems this company as extremely high valued. And now, when considering risks and possible challenges, this company has such a wide moat that I do not believe that the competitive landscape can worsen for them. Now, the major risk that I believe in is them not being able to meet performance objectives. They have been increasing prices so fast and by such high quantities in the past that this may be raising concerns for, first of all, regulators, and second of all, clients, which, if the prices keep going up so fast, may be keen to develop a competitor or a substitutive product, which may hurt FICO's revenues. So I believe that they should focus more on maintaining long-term quality relationships with their clients instead of focusing so much on leveraging their price power and their competitive advantages. So now, before we move on, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a very, very strong competitive advantage, which produces consistent cash flows, which gives predictability to the stock, and it has high return on capital employed, meaning that it knows how to create value for the investor. So I believe that this is a good company, but I am hesitant whether this will be a great investment since it is trading at such a high valuation that we will have to see where it goes from here. So thank you for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content, and there's a link in bio for a free stock if you join Trade Republic.